Welcome back. We are back here to break down another Fed decision. June meeting was yesterday. Connor O'Brien, portfolio manager, trust investment officer, is in the hot seat with myself, PJ Schaefer, trust investment officer, portfolio manager, to break down a Fed decision meeting that was really, really widely anticipated. Now, I do want to acknowledge we are on a one-meeting hiatus. Congratulations to Connor O'Brien on the newest addition to his family. Connor, your daughter is what, six weeks old now?
7 weeks on Monday. Yeah, thanks, PJ. It's great to be back after a brief hiatus. Many apologies to our fans and followers. My wife and I should know better than to have a baby around Fed meetings. It won't happen again. But for all those anxiously awaiting, we are back.
Perfect. So like I said, this was a pretty big meeting, so let's just jump right in. Connor, as always, what happened and was it expected?
Yeah, so for the first time since January of 2022, the Fed had a meeting and did not raise the Fed funds rate. This short but very, very swift rate hiking campaign began just 15 months ago. It was not that long ago. They've raised rates for 10 consecutive meetings, a total of 500 basis points. Looking at Fed funds futures, you could see how rate expectations sort of continue to get pushed out and up. So right after the 2-week banking crisis, expectations were for the Fed to actually start cutting rates at this meeting. And we realized pretty quickly how idiosyncratic of an issue that was, while at the same time, economic data has been really, really strong. And obviously, strong economic data equals firmer inflation expectations, which equals higher interest rates. And so you've seen the market now start to sort of price in a Fed that's less likely to start cutting rates anytime soon. Now, as far as expectations go, really only a few weeks ago, the market was expecting a hike at this meeting. The theme of really the last year has been stronger than expected economic data, and we saw a continuation of that at the end of May. You had firm PCE data, you had an upside surprise to JOLTS, to job openings, and you had a strong payrolls report. And the market at the time put about a 65% probability of a hike at this June meeting. A few things happened at the beginning of June to sort of squash that. So you had some dovish Fed speak from Philip Jefferson, who's set to replace Lael Brainerd as the vice chair of the Fed. And you also had an inline CPI report on Tuesday of this week that really put the nail in the coffin and assured a pause at this meeting.
So we can see on the chart a 98% chance of a pause coming into the meeting. We got the pause. The market yesterday was ended flat, but anybody that flipped on CNBC after about 1 o'clock really saw anything but flat. So walk us through that.
Yeah, so you'll recall from our previous videos that there are two parts to these fun Fed afternoons. The release of the official FOMC statement at 1 p.m. Central, our time, and then Powell's press conference at 1:30, where he answers questions and talks to the press. We get a fun little kicker every quarter, once a quarter, and that's where the Fed updates its summary of economic projections, its SEP. So you can see, 1 o'clock, the SEP and FOMC statement came out. Markets fell off a cliff, yields spiked, and then Jay came in and calmed things down at 1:30.
Yeah, Fed Chair Jay Powell definitely had a masterclass in his press conference, but let's focus a little bit more specifically on that 1% downdraft right at 1 o'clock. What happened there?
Yeah, so the official FOMC statement didn't really move the needle. It's several paragraphs long. They really only updated 2 sentences, indicating that economic strength has continued, that they're maintaining rates rather than raising rates, and put a little clouded promise in there to potentially raise rates in July. But that is not what moved the markets. The SEP is really what caused the markets to nosedive and fall off a cliff at 1 p.m. There were some notable changes in this summary of economic projections. First and foremost, they increased GDP expectations substantially. They also lowered the unemployment rate that they expected at the end of the year, and they bumped up their specifically their core PCE inflation expectations. But really what moved the markets was that 5.6% terminal rate expectations. What that indicates is that they will look to raise rates and expect to raise rates 2 more times before the end of this year and end the year at a 5.6% Fed funds rate. The market looked at that and said, oh, that's not good. That's higher than anyone projected or expected. And the theme of the press conference at 1:30, right, because this came out, the markets dropped, and then really as soon as Jay Powell started talking, things started to ramp. The theme of the press conference was the press asking if you're going to raise rates so much, right, as you spelled out here, why don't you just do it today? Why not do it now? Powell did a very, very good job of saying, look, inflation is moving in the right direction. We'll pause and leave ourselves optionality. If rates fall off a cliff and markets rip and animal spirits return and people start buying digital images of monkeys and rocks for $8 million, we'll raise rates. We'll have to raise rates more. But if inflation continues to drift lower and the labor market holds up, we have room to cut. There's no reason we can't cut. And the market's really acknowledged this. And in fact, Fed funds futures right now aren't really buying the 5.6% terminal rate. They're expecting maybe a hike in July, and then for the Fed to kind of hold rates steady into the end of the year. So maybe up to 5.25, but maybe staying here at 5. And the market, specifically the equity markets, responded favorably to that. And it was all thanks to Powell kind of pouring cold water on that high terminal rate.
Yeah, I think Jay Powell, the big takeaway there is just maintaining that optionality. Like you said, let's have time. Let's let this work through. We don't want to over tighten. That's a big concern. Back to that sort of over tightening, this Fed funds rate, 5.6%, just as you mentioned, the Fed is trying to get across, hey, we're going to do 2 more rate hikes. The market is saying, nah, we don't really believe you. Where is legacy? Where's our view on that?
Yeah, so we're inclined to work and believe the market. It obviously all comes down to inflation. And as I said, the easy part is over with inflation, getting from 9% down to 4% in headline and 6.5% down to 5% in core. And getting from where we are today down to 2% is really kind of where the rubber meets the road, because we still have a ways to go. But the Fed is no longer behind the curve. The Fed funds is pretty much at or above every measure of inflation that you can find. And the path of Fed funds going forward will really be determined by CPI, specifically core CPI. Powell harped on core CPI yesterday. If that continues to drop, and there's structural forces that will likely pull core CPI down between now and the end of the year, specifically in housing, along with just base effects. So if you get a sort of gradual decline from 5 to, let's say, 3.5 before the end of the year, which is certainly not out of the question, we're much more inclined to go with the market. And you might even find us a bit more dovish than the market, where if at the end of the year, core CPI is at 3.5 and Fed funds is at 5 and the labor market is still tight, there's no reason you can't start pricing in even more rate cuts than what Fed fund futures are saying right now.
So kind of really quick, you mentioned sort of CPI and core CPI. And for a lot of our listeners that may not know the difference, what is the difference between CPI and core CPI, and why is it important, and why does it matter?
Yeah, it's a great question. So very simply, core CPI excludes food and energy prices. And food and energy prices make up about 20% of headlines. So you're sort of stripping out 20% of headline CPI. The Fed, or the BLS, strips that out for really 2 reasons. First and foremost, it's inherently less volatile, right? Food and energy prices are more volatile due to the fact that they are prone to big supply shocks. So, the price of food is subject to supply shocks from, let's say, a bad drought season. And obviously, oil is subject to the whims of OPEC. So monetary policy really can't influence anything when it comes to those supply shocks. And remember, the Fed is focused on monetary policy. So, when they look at core CPI, it's more them looking at more of what they can control rather than things that are out of their control. Now, it's important to note that when we say exclude food and energy, it doesn't mean they're ignoring it, right? They obviously still look at all of this data and a whole lot more data, right? There's this misnomer out there that the Fed is only looking at core, or only looking at this, or only looking at that, and stripping out this and that. It's just wrong. The Fed looks at inflation 1,000 different ways: core versus headline, goods versus services, X shelter and including shelter. They slice and dice it all.
Yeah, I mean, even just on that volatility of food and energy, I mean, you can see it on this chart, right? The light blue line obviously goes up and comes down quite a bit faster. That is going to include food and energy, and the navy blue line excludes it. It's a little bit more stable. So moving forward, Connor, what are we looking at? What are some major data points that we have on the horizon?
Yeah, 2 major economic data points and a few other things to pay attention to. The first is just non-farm payrolls at the beginning of July. So labor market has been really, really strong. We'll look to see a continuation of that in July. And then you also get June CPI on July 12th. Likely you'll see sort of probably a 0.4 increase month over month in headline and core. That would bring headline inflation down to about 3.2, maybe 3.3. So probably a low 3 handle on headline, and it'll bring core from about 5.3 down to 5.1 maybe. So, a continuation of this deceleration in inflation. We also get a few other, fun, I guess, non-economic data points. You get some Fed speak that'll probably pick up here. The blackout period ends today, so starting tomorrow and all of next week, you'll get probably a bunch of Fed speakers. You also get Q2 earnings season that unofficially begins July 14th with the big banks.
Perfect. So we're about 6 weeks away from our next July meeting, which Powell, as Connor mentioned before, said that is a live meeting. So we may be seeing another 25 basis point hike, or we may see a continued pause. A lot of that data is going to come on July 12th, CPI. So we will stay tuned to that. For those of you, thank you for listening. Thank you, Connor, for being in the hot seat again. That July meeting, I think I will be back in the hot seat. So looking forward to that and taking Connor's tough questions. If you are a Legacy client and you have questions, please do not hesitate to contact your Legacy advisor. If you are new to Legacy and just interested in what we do and how we manage money, please feel free to reach out at info@lptrust.com. Thank you.